Hello everyone, welcome back to our YouTube channel. It is currently November 2nd on the East Coast. In today's video, I will first walk you through my personal trading plan for Meta, followed by some general setup ideas for next week. We saw fresh buy signals pop up on a handful of names this past Friday, and they look quite interesting. However, a key point to remember is that next week is packed with earnings reports, including for several stocks we are watching closely. So before we dive into any specific tickers, I want to emphasize that position sizing and risk management are absolutely paramount right now. As we hit the peak of earnings season, many stocks that previously looked like good entry opportunities now need to be treated with a risk-off approach. This means either scaling back your size or stepping aside to wait and see. Avoid building a large position aggressively. It is generally safer to let the earnings report land and let the market digest the news before making a decision on direction. Just a quick reminder here, and we will revisit this when we discuss individual stocks. Let's get straight into today's content, starting with my follow-up plan for Meta. A lot of you have been asking about Meta since it sold off after earnings, wondering if it will recover and if it is time to buy. Here is my take. If you are expecting it to bounce back immediately tomorrow and swiftly re-enter a confirmed uptrend, that is very unlikely. My personal view is that Meta will probably need to churn around at these lower levels for some time. Then it should slowly find a base and gradually work its way higher. Therefore, any trade on Meta right now is a pure buying the dip play, entering while the trend is still technically weak. I want to be perfectly clear about my own plan for Meta before we look at other stocks. You all know my typical style is to trade confirmed, strong uptrends. The vast majority of my trades, 80 to 90%, are in that category. Meta represents one of the few times recently where I might step in early before the trend has officially turned. Firstly, the company's core business is still solid. The main worry for everyone, including myself, is their massive capital spending and whether they can eventually turn these investments, especially the even larger AI-related expenditures planned for 2026, into real profits. From a technical standpoint, all the previous uptrend support levels have been broken. It is now in a defined downtrend. So, if you want to trade it here, you are adding on weakness because nobody can call the exact bottom unless you wait for a new uptrend to be established. If you choose to get into Meta, now you are making an early counter-trend entry. You must have the mindset that the price will not necessarily recover for you next week or next month. You might need to hold for a fairly long period, perhaps 6 months, a year, or even longer. I am mentally prepared for that, and I am willing to make this early play. So I will participate. If you are not prepared for that kind of timeline, then it is best to avoid Meta for now. Wait for it to reclaim a confirmed uptrend. For instance, wait for a 1-hour or 30-minute bottom to form according to our indicators, and then follow that signal. But that is a story for later. As of now, with no such signal present, it remains in an early, weak phase. So how would you approach it if you do want to participate in this early phase? Here are the key levels I am watching. The first level is right around the current price, $650. I already established a starter position here last Friday. I initiated a half-size position. My standard full position for a large company like this is typically a 5% portfolio allocation. For this initial entry, I took less than half of that, roughly a 2% allocation. I plan to use 4 or 5 separate tranches to build this position up to around 10%. That is my ultimate target for Meta. I will likely keep a final 2 to 3% in reserve to handle any unexpected sharp sell-offs, but the total position will likely end up between 10 and 13%, not exceeding that. This is the weight it holds in my overall portfolio. With that size in mind, I will scale into this position over several buys. I will not go all in at once. Each addition will be made at a relatively critical technical level. The first buy was at $650, which is done. The next potential add would be around the $600 to $620 gap area. That is a zone to consider. The next level down is around $570, which is another minor gap. The area between $570 and $550 is another consideration. Then my final watch point is around the April low, near $480. I would roughly split my buying across these 3 general areas to reach my target 10% allocation. The initial buy is smaller, around 2%, and subsequent adds could be a bit larger, especially if the price drops more. But the total will not exceed that 10 to 13% range. This will be a longer-term hold for me. It is a long-term investment accumulating on weakness. Okay, that is Meta. If you are interested in this early play, you can use the levels I mentioned as a guide. If you prefer not to focus on specific support and resistance zones, you can simply watch the major psychological numbers like 600, 650, and 550. The price action tends to respect these areas anyway. You can build your position around these general levels. It does not need to be pinpoint accurate. If you are making an early entry for a long-term hold, you do not need to get the exact price to the dollar. Being roughly correct in the zone and accumulating your size over time is the goal that covers Meta. Now, let's discuss our usual trend, following setups. First, let's look at ONDS. This stock showed coinciding buy signals on the 1, 2, 3, and 4 HOR timeframes on Friday. You can see its previous 1 HOR bottom had a decent track record. Its last 1 HOR signal was on Wednesday, October 22nd. It rode that big market rebound wave up, but then it pulled back again, right? Back then. I likely suggested starting with the 5-minute chart. After the 5-minute bottom formed on Wednesday, you could have taken a position, and after it stabilized into Thursday and Friday, switched to the 30-minute chart the following week. If you had bought that bottom and followed the plan, you could have banked a profit in the 15 to 20% range, depending on your exit, roughly in that ballpark. For the stock itself, 15% was definitely achievable up until the 30-minute breakdown option returns would have been higher. Looking at the current potential setup, the 30-minute level does not look great. It hit a low around October 30th, but the follow-through was poor, so the 1 HOR level seems more promising. If this small triangle pattern on the 1 HOR chart can break upward and hold, then it becomes tradable. The key level is around $6.50, so the plan is to first trade it based on the 1 HOR signal. If the trend continues to strengthen, then we can consider moving to a higher time frame. For now, just manage it as a 1 HOR trade until it proves itself. Once it breaks and holds above 650, and the green indicator triangle confirms, you can enter, okay, this is one stock that might be actionable soon. But remember my usual caveat. A 1 HOR signal is for a shorter-term trade. Secure those gains first before thinking about a larger move. Do not immediately shift to a bigger picture view before the trend is stable. Right now, overall market action for individual stocks is still a bit shaky, so treat this as a short-term trade to manage risk, and we can look for bigger profits later if it works out. Better to be safe now. Amazon, it previously had a 4 HOR bottom signal. Looking at it now, it has not given back much of its post-earnings gains. The logic is the same as for Google. As long as this upward gap from the earnings pop remains open, you can continue to hold. I am looking at a minimum target of $230. If this gap gets filled, and at that point the fast line on our 4 HOR indicator has not caught up, then consider taking profits, but that has not happened yet. For now, it remains a hold. Generally, you would look at whether the 4 HOR trend fast line is higher or the bottom of the gap is higher and use the higher of the two as your profit-taking guide. I will cover Google shortly. ISRG is a perfect example of this same idea. Look at ISRG. It also had a 4 HOR signal before reporting solid earnings and gapping up. I never suggested selling it because the rule is not to sell immediately during a sharp gap up. Wait for our indicator's fast line to catch up before considering an exit. For ISRG now, the 4 HOR line has caught up, so going forward you can continue to hold based on the 4 HOR or even the daily chart. It has been a nice runner. Let's talk about PLTR. I have a plan to add to this position. My previous trade in it was based on a pullback to the daily chart support. I told you before it was stuck consolidating between $180 and $190. You can see it traded sideways there for a good while. Then last Friday, it suddenly broke out, moving decisively higher. I mentioned that if it could stabilize above $200, I would open a small starter position. However, everyone needs to be aware that this stock reports earnings next Monday, which is a significant risk event you must respect. I already added my small position. Once it closed above 200, I bought in. My size is small because of the upcoming earnings. It makes no sense to load up heavily right before a report, right? You all know I am a fairly risk-averse trader, so this position is intentionally light. My reasons for taking the trade are twofold. First, its past earnings reports have generally been good. Second, it has shown this technical breakout. Of course, neither of these factors guarantees future performance. Good earnings in the past do not mean this one will be good. Furthermore, technical signals, whether bullish or bearish, become largely meaningless right before an earnings report. The fundamental sequence is this. First, a company operates its business and creates real-world value. Then investors and traders buy and sell based on that value or their expectations for it. These transactions create price movements which are recorded on the chart as historical data. Finally, technical analysis categorizes and summarizes this data into the signals and patterns we see. So the company's operations drive the price action, which then drives the technicals. Technical analysis does not influence the business itself. Therefore, do not assume a technical breakout predicting higher prices means the earnings report will be good. That is not how it works. There is no correlation. If you want to take a gamble on an earnings report, just keep your position size very small. Personally, I am relatively optimistic about PLTR, so I am willing to risk a small amount on this play. If I win, great. If I lose and the position goes to zero, it is a manageable loss. Okay, I want to be perfectly clear on that. For those of you already in the trade, we initially entered based on the daily chart setup around $170. The standard plan would be to hold until the daily chart signal breaks. However, with earnings next Monday, it is perfectly reasonable to adopt a risk-off stance and reduce your position size before the report. There is no problem with that. If the earnings turn out well, you can always consider adding back or chasing the move higher. But if you are carrying a heavy position, you really should think about trimming it down to manage your risk. The stock tested the 170 level on the daily chart numerous times. It is a very dense consolidation zone that lasted quite a while. Without the earnings overhang, I would be very confident in a continued move higher given the technical breakout. But the earnings report introduces a major variable. Since it is a variable, I cannot recommend anyone trade it. I can only state my own plan. If you want to participate, that is your call. If you would rather not, there are plenty of other opportunities. Next up is HIMS. This is a stock many of you have been watching. I have said numerous times that it tends to find technical support around the $41 area. We have seen it bounce from that level several times in the past. However, the old issue remains. HIMS reports earnings next Tuesday. When a company is about to report, all technical support and resistance levels become secondary. An earnings report can easily overpower any technical analysis. If the earnings are bad, there is no guarantee it will hold at 41. We would have to wait and see. For now, watch to see if an entry opportunity develops around 41. From the current price near 45 down to 41 is about a 10% drop. A 10% decline on bad earnings might be a reasonable worst-case scenario. Afterwards, watch to see if it stabilizes and finds a bottom around 41. If it does, that would be a much safer entry point. For now, best to leave it alone. If you are determined to gamble on the earnings outcome, keep the position tiny. As always, no need to say more. Next stock is ZETA. This one showed a 4-hour buy signal. In fact, the 1, 2, 3, and 4-hour charts all flashed bottom signals last Friday. But again, the big caveat is that it reports earnings on Tuesday, November 4th. That is a major risk. If you are not planning to hold through the report, be very cautious. View these technical signals as just a reference. If you want to trade it, it is far safer to wait until after the earnings dust has settled. Do not commit your full size immediately just because of the signal. You have a major event looming, so discipline is key here. Keep any position very small. A quick note on United Health. There are a couple of points for UNH first. The stock broke down below the $350 level on the daily chart. As I said before, a daily breakdown is a clear exit signal. I have already sold my position. If you are looking to re-enter later, watch the $330 area for potential support. It did bounce from there last Friday, but the future is uncertain. There are two potential scenarios for a new entry. First, if it finds support around 330, specifically if you see a clear halt and potential reversal signal at the bottom of our indicator's yellow zone, you could consider a short-term trade. You saw a hint of this on Friday near 330 with a long lower shadow forming right at that support level. On the smaller time frames, a 30-minute buy signal appeared. If you are agile, you could potentially enter based on a small signal, like the 10, 15, or 30-minute chart. With the 30-minute being preferable if it holds, you would be trading for a short-term bounce. The second scenario is if the stock manages to climb back above 350, you could consider buying it back as a trend re-entry play. Okay, that is the United Health plan. But for now, with the daily chart broken, the overall bias is to the downside, unless it either powerfully reclaims the 350 level with strong volume or it definitively finds support and reverses from this current yellow zone. I have no immediate plans to trade UNH. Let's discuss NVDA. First off, the 1-hour chart for NVIDIA looks very healthy. Since the bottom formed back on the 22nd and it rallied, it has not really tested support significantly. The action has been steady. There is no pressing need to reduce the position yet. I previously advised taking some partial profits up near $210. Since then, the plan has been to continue holding based on the 1-hour trend. For now, holding as long as it stays above the $200 zone looks fine. That is NVIDIA for now. Its earnings report is still a bit further out, so we have some time. My suggestion for when we get closer is this. If the stock experiences a strong run-up before the earnings report, I strongly recommend taking some or even most of your profits off the table ahead of the announcement. Do not hold a massive, full position into the event. Let me be clear, my fundamental outlook for NVIDIA's earnings is still positive. Their reports have been consistently strong. However, for a stock like NVIDIA, good earnings do not automatically mean the stock price will go up. Market expectations are already sky high. It is entirely possible for them to report excellent numbers, beating on revenue and earnings per hair. But if they do not massively exceed those lofty expectations, the stock could still sell off. That is my personal plan for NVIDIA. If the 1-hour trend remains intact right up until the report, I will be scaling down my position size significantly before earnings. Google is straightforward. The plan remains the same as before. Continue holding based on the original daily chart buy signal. I still think simply trailing the stop based on the daily chart is the most sensible approach. It has done a decent job holding most of its post-earnings gains without a major pullback. One thing I am watching closely is that gap up level. If the stock were to fall back and fill the gap, meaning it drops back below, say, $270, then I would start to get concerned about Google. But unless that happens, I have no plans to reduce my Google position for now. The rule remains hold as long as it stays above the daily signal level around 255 and exit on a break below that. You could also add a more proactive rule. If it breaks below 270, taking some profits early might be a prudent move. Next, let's talk about ALAB. A few people asked about this one. Similar to others, it printed a buy signal on the 30-minute chart back on the 22nd and performed very well. As another week passed, the signal strengthened to the 1-hour time frame. If you have been holding since last week, you are sitting on a very nice gain of around 24%. It has been a strong performer. The standard plan for a stock in this position is to hold as long as it remains above the 1-hour support level around $177 and exit if that level breaks. You would normally just follow the 1-hour indicator. However, the complicating factor is that ALAB reports earnings this Tuesday. Therefore, it is wise to reduce at least a portion of your position before the report. For any shares you keep, continue to hold based on the current 1-hour signal level. That is the plan for ALAB. It has been one of the better performers. Basically, since that initial 30-minute signal on the 22nd, it has been one of a handful of stocks that just kept climbing without a significant trend reversal. Remember, many stocks had buy signals on that Wednesday, the 22nd, and they rallied, but most weakened again within a week. ALAB, along with NBIS, and that nuclear energy stock I mentioned, are among the few that have shown relative strength, barely pulling back since the initial move. ALAB can still be held if you are already in, but if you are looking to establish a new position now, it is probably better to wait until after earnings to reassess. Right now is the time for existing holders to consider taking some risk off the table. This highlights a frustrating aspect of the current market. Many stocks are flashing technically interesting signals right before their earnings reports, making them tricky to trade. My general advice is this. If a stock has a buy signal but is reporting earnings imminently, it is usually best to hold off on entering. If the earnings report is bad, those technical support levels often provide little defense and can get sliced through easily. The stock can drop sharply regardless of the chart. Finally, let's touch on a couple of the slower moving stocks we have been holding. First, AMAT. Its earnings are on the 13th, so we have a little more time. The same principle applies here. If it experiences a strong pre-earnings run-up, Take some profits off the table beforehand. Reducing risk ahead of a major binary event is a good rule of thumb for any stock that has run up into its report. All right, everyone, that wraps up today's market update. If this commentary helps shape your own trading ideas, please give the video a like to show your support. Do not forget to subscribe to the channel and tap that notification bell so you never miss our future strategy sessions and trade recaps. If you have any questions or have specific stocks you would like me to cover, just let me know down in the comments section. Thanks for watching, and I will see you in the next video.